Hi folks, A-7 trading course is about how to master time frames. Upon the completion of this course, you will see that how you master to make all the time frames to say the same things to you, and how can you summarize all the market structures of higher time frames, which have give you much bigger picture in the lower time frames where you use that for entry and exits. I think the time frame mastering time frame is a very common issues for almost all the traders. Somehow you have to find a way or a strategy to master that. So we will try here to give you some very useful techniques and tricks as usual to help you master time frames. Okay, let's do it. Before we start, please make sure that you pause the video here and read our disclaimer before you continue. Once you continue, you have accepted, agreed with our disclaimer here. Okay. Before we go for on the charts and show how we can master these time frames, I think it's very important we outline some very basic principles for time frames, and these principles are extremely important, and I strongly recommend that you make sure that these are part of your trading plan or your personal strategy, because this will help you and refresh your mind each time you review your strategy or review your trading plan. Okay, so the first one is use the daily time frame for identifying main trend. This is extremely important because you should never ever trade against the main trend in the lower time frames. The risk is very high that it will go against you. So you have to always do in lower time frames when you are entering. You have to make sure that you keep that the main trend on the higher time frames in mind, and make sure that you are trading on the same direction as the main trend, and never go against the main trend directions in lower time frame. That will be a big failure. Okay. The second principle is they use higher time frames to look at the bigger picture of the trend. This is very normal. Okay, we mentioned on the number one that daily time frame, you can use weekly time frame as well. You can use a Q10 strategy. If you have not seen our trading course about Q10 rules, how to how to read the charts, please make sure that you watch that video as well. So the third point is to use lower time frame for entry and exit. You usually use that. Why? Because you wanted to be quick in entering and exiting, so that will be in your advantage if you do that. If you go on the higher time frame to make that decision, that will be a little difficult and hard. Okay, so always use the lower time frame for exit and entry, and then use these I call it 4x4 rules of multiply time frames, which basically means that you are using multiply time frame. Make sure that when you go when you are zooming in or you wanted to go lower time frames, you divide that current time frame by 4, and if you go you zooming out and you're going higher time frame, and then you multiply that by 4. For instance, if you have time frame 1 hour, 1h, and then what you do, if for going lower time frame, you divide that 1 hour by 4, you will get 15 minutes, and then if you times that's you have to look at the time frame, that time frame, okay, and 15, and then when you go for the higher time frame, you multiply that 1 hour by 4, that you get the time frame, 4 hours time frame. So here you use the rules 4 by 4. This is very, very important, that you should never use less than 4 for choosing multiple time frames. Okay, so the other principle is that use minimum 2 time frames. I would strongly recommend that you use at least 3 time frames, but the 2 time frames will be okay. Also depends on your personal strategy. The minimum are 2 time frames, but is recommended one is 3 time frames. Okay. Use lower time frames with higher time frame market structure in mind. This is extremely important. Why? Because you cannot use the lower market structure to contest the higher market structure. You will never win. So you have always to have that in mind, the market structure. So the best things you can do is to transport that market structure from a higher time frame into your short time frame, and use that short lower time frame with that market structure, but never use the market structure in the lower time frame. You will use only the price action. You will go only for price action in lower time frames. Okay. Number 7, never trade against the trend of the higher time frames. Okay, but we go back again to the here main trend to number 1. So when you are on the lower time frame, make sure that you are always trading in along with the trend, not against the trend. That is very, very important. Make sure that you make the trend, the main trend on the higher time frames, your friend in the lower time frame. Never ever go against the main time frames trend, unless you are scalping traders. For the day trader, swing trader, and a holder or position traders, they should never go against the trend in the lower time frame. Okay. Number 8, all time frames should tell you the same thing. That is exactly the purpose of this trading course, that we basically make sure that all the time frame that you are looking at, they give you the same market structure, the same price action, and it will give you so much information that all time frames are saying the same things. If all time frames are not saying the same things, then you have to stay away from trading, because that is basically there is something wrong. There is a mixed signals there that will not be in your favor at all. Okay, larger time frames are more significant than the lower time frame. Keep this in mind. Keep this in mind that the larger time frame are more significant than lower time frame. Why? Because of the nature of the market structure that they are providing you. Why market structure? Because on the lower time frame, what price actions is personal things, a personal strategy, but market structure goes back for a common tool or common things that most of the traders on the market, most of the players on the market are using the same market structure, or very, very close to the market structure. So that means basically that is not your personal things. That is something that is helping you, giving you so much information about what is happening in the market, or somehow reading other players, other traders' mind in order to make your price action correct. Okay, make higher time frames your trend time frame trend your friend. This is something very common, that everybody says that make your friend the trend your friend, and not go against that. Okay, before we go to how to choose correct time frame on this, I would like to go to the chart and see and apply all these 10 principles there, and see how much that will give you all information, and how we can master the time frames by using all these 10 principles here. Okay, let's do it. Okay, folks, here I have three time frames here, three charts with three different time frames based on the crypto index 10 index. I use that because most is very popular right now. So what we have it here, I have here the 15 minutes time frame, that is 1 hour time frame, and that is a 4 hour time frame. Okay, so here I have 1 hour divided by 4, I get 15 minutes, and multiply by 4, I get 4 hours. So that is enough for me. So I will use this time frame, this chart for 15 minutes time frame only for price action. But before I do that, I have to make sure that this chart tells me exactly what is this saying, what is the 1 hour time says, and what is the 4 hour time says. So we have to make sure that this chart give us exactly what this says. If they says the same thing, then it's okay. If not, then we have to go, we have to stay away from that, from trading. Okay, let's go for the time frame for the 4 hours. Okay, here we are looking, basically we are not looking for entering or exiting here, but we are looking for finding the market structure. So the market structure basically means that we will look for the resistance or supports or channels and all these. So if I do that very simple, here I see that there is a market structure that is giving me, okay, downtrend, which is used as a resistance. So that is very, and you see that is it coming out on all my 3 time frames. If your platform, this is the feature that my platform has. If your platform does not have this feature that you cannot link, if you see it here, I have linked all these charts. If you cannot link this chart together, then it's very simple. You can basically look at that, what level is that, and then draw a line in the time frame, 1 hour's time frame for the same, and then draw a line here for 15 minutes for the same thing. Okay, so now we will look at that, if we can find any other channel, any other market structure and all this. So what I see that I see something very, very good actually, depending on the volatility or the volatility or the range of these assets. So I can see that there is a very strong support here. So I will use that support. So because we are looking at this, basically the most important thing is we look at that, okay, what is the main trend on the biggest one, and also if we can find support and resistance here. So we did that again because I have reflected that. So I have both here. So what I will do, in order not to mix it up here, just for your things, so I will call them call these 4 hours, so we know which one is which one. Okay, so I call this one also 4 hour. So these two we got that from 4 hour time frame. Now we will go for the market structure and the trends on the time the 1 hour's time frame. We see that trend, that the downward trend here is also showing very nice, very good. So what we will do, we will look at that. Okay, if there is any market structure, we can do further market structure support and resistance here. We can find that beside that what we have find it out in the other time, the higher time frame. If you look at that, so we can connect these bottom, this bottom, and these highs. So that is basically they give us very good support to identify that. So we basically we use that as our what is called as support here, because these, if you look at here, we have one shadow that is coming here, and then we have one bottom here, and another bottom here, another. So you have one touch, two touch, three touch that is here as a support, and then we have another touch here again as a support, and then we have some touch here as a resistance. Okay, so if you go look at, if we have more things here to identify, yes, we can identify here that we have something else as well. If we connect this one to that one, so we somehow we see there is also support here as well. So if you look at that, because I have linked it, because I have linked these together, I will just make a little straight, if I can do it. Anyway, I think you guys understand that. Okay, I managed to do it. Look at that, how nice it is basically is reflecting here. So it is here we have the touch there, and we have one touch here that goes up, it hit it goes up, and one touch here, and then another touch here, and another touch here, and then touch here. So this basically is a valid support for us. Let's for simplicity call these also 1 hour. So I call it 1H. Okay, sorry, 1H. Okay, so we have one H here as well. So I will close this one, and I see okay, just bring it here to make it nicer. I will see if we can find anything else here. So I think it's very obvious that we have kind of another horizontal resistance here. So we will do that as well. So we basically we touch this all here, and then that goes here, and that is touching. So it's very nice. This is also a valid resistance here that is obvious. So we call that one also. So that one here, that one we call it for 1H. Okay, just to simplify for us to understand what is going on. So okay, so we have that is 1 hour. Okay, so now we got everything we needed to go further. Okay, no, we don't need actually to look at this chart. We can close this chart and do focus on here on our price action for that, and see when it gives us the opportunity to enter. Okay, so what we will do now, we will look at that. Okay, find place for example, to enter it. Okay, so here we will let's basically look at here. So here is very interesting, because here we know that, okay, within 15 minutes each of this candle is equal by 15 minutes. Okay, so we see that 15 minutes it here that hits these H1 and H4 for 1H and 4H. It breaks that, and then we will look at that whether that is a real break or not, and then it continues and it's coming down, and then it falls with a very long candlestick, and that candle a bearish one. And then when it comes here, the interesting things is if you look at here, we are below the price. This is a valid if you have not watched my moving average strategy video, please watch it, that because some stuff thing that I will use it here, you might it might be interesting for you why I am doing this, how I am finding these points. So it's better you go and look at the moving average strategy. That video is very important. So here, based on the moving average strategy that I have told you, is we see that the EMA, this blue one is EMA exponential moving average, the 20 exponential moving averages that cross this big bearish and goes above. So what that means, basically, we see that, okay, this is a key area, and then we look at that this that is crossing the candle and is going below above the price. That is basically what is telling us. That tells us okay, that is basically our entry point. Why is entry point here? Why we are not looking, we did not look at on this breakout to say that, okay, here is the break. Why? Because the main trend, the main trend for higher time frame, which is this one, it tells us that the main trend is downward. So we should always focus on going long short position here. So we enter here, we let it go. Okay, we know that we have this EMA, SMA here, SMA 100, and we have SMA 200 here, but we because they are very close each other, we don't bother too much here. Where we see that the main trend here is down, and we look at that. Oh, now we are coming close to an area that is basically 1 hour that is a market structure that it tells out, okay, there is a strong hourly support here. So what we will do, we will say, okay, we look at that, either we to see if it's gonna to break or it's gonna to bounce. So once we see that there is a hammer, that is you see that how is price being rejected here. Once we see that the price is being rejected here, we know that this will be bounced back because of this key area that is here. So this price rejection here has told us that is gonna go the upward, and then we wait a little more, and in the hope that it will be good breakdown before we exit that, and then we have this 15 minutes later we get this big candle here, bullish, and then what we will do, probably we exit here or we exit here. So it depends on basically where to exit. So you exit here, you exit that, and then you wish to, okay, you look at that, okay, you say that, okay, no, it has been rejected here, it will bounce. Okay, I should ride the trend here, but that is basically goes against the main trend here. You need to be careful here. And then what you do, you look at the strategy for the EMA hat. It will be, you will never enter here, never ever enter here, because that is far the prices are far below the EMA 20 and EMA 50 and EMA SMA. They are far from each other. So that means basically this downtrend is very strong. So we have to get the confirmation. How we get the confirmation here? If you look at that, the EMA cross that bullish candle from above, and we look at that if it goes below or not. It not goes below, but it again cross a bearish candle. That means basically these by rules that we learned from MA strategy, moving average strategy, this is cancelled. We will not bother about this because this crossing, because it did not went below the price, but it went through another bearish candle. So we look at that again, it goes above the prices, and then it comes here, and then it touched that, and then again, because it touched this candle and then touched this candle, we will not consider that, because we said that it has to go like this, crossing the what is called the candle. And once then we come here, once we come here, we will see that okay, here it's basically here it basically gives us the signals. So it's because it's crossing, but here there is another confirmation that gives us, and then that is because it's going through above. But the problem is that is basically hitting that candle, bearish candle. So we will not enter, and then we will want to get, probably we will move from here. So we have to, here is the best prices to go, but here also it was the signal to go. But if we should follow the strategy that we have, that for the to make sure that here is more confirmation, or here is not confirmation. So here you enter for sure, and then you go up, and then you hit that one, and you know that this is okay. Look at that how nice it is. So because you know this is a key level, you know that is get. So here you will basically you will exit here. I think the best strategy is, because you gonna, here you go against the trend with very small profit. So I strongly recommend that you just you stay away when you don't get the signal well near to this key level, so you don't go enter when you are in the middle of this horizontal channel. So it's very risky. So this is not recommended. So here you have definitely to exit. Why? Because it's uptrend again. You see that if you look at that, here itself also trying to make it lower. So look at that, how much here information that God gives you, that is coming from this chart here. So what we will do, then we will try to now find a position to basically to enter. So we will look at that, what does that. So we again we do it hits the 15 minutes here, 15 minutes here, 15, almost 1 hour, it hits this support to break it. It cannot break it, and it falls down because we have this EMA that is making a knot here. So we need to be careful that it will move to one side. Either it will go very quick up or down, because this gravity of the of the moving averages that getting making a note here. And then what is happening, then we see that EMA 20 EMA is crossing this bearish one, but that is because it's touching that candle, that green candle, that is cancelled, that is not valid. And then we look at the EMA 50 is crossing that one, is very perfect, and that is basically going about the prices here, about the prices. So what is happening basically is right here, it give us the signal, very strong signal. Why? Because EMA the 50 EMA is crossing that candle, and then crossing that candle as well, it go above the prices, and that tells you okay, now is time to enter. So we will now go short position, because we are very happy to go short position here because of this main trend line trend for in the other time frames. Okay. And we did not enter it here because of we did not enter it here because of the roles for these moving averages that making a knot here, which means they are concentrating with each other and they are touching with each other and making a knot, and we have to look at that. what we know that on one side it will go very very quick. So but then we see that there is a drop here, and then we look at that okay, the in moving average to 50 is below the prices here, and then they cross that one and then go over, and then we enter that. Okay, we enter that, then the price falling here, the price falling here, now we coming here. So there is two option here, either you exit here, either you exit here or you wait. Why you should what will make you tell it? Because you look at that, okay, this is 15 minutes chart, okay, so 15 minutes candle, you see that, okay, within 15 minutes this is happening, wow wow wow, so quick is coming. So maybe it's worth to, like here, that we give that some time to instead of just exiting here. So you give that some time here, either you exit here or you give that some time, see that if it's bouncing back with this sharp fall, or is gonna continue. And you see that it's continue, and then we look at that point again, but we did not have a chance to look at that point. Why? Because it's so strong, this fall within 15 minutes. So we let it go because we know that we let it go here because we know that, okay, this is hourly, and then we know that there is a 1 4 hour here, 1 4 hour here, and then what is happening that within 15 minutes it is hitting that, and then it is becomes a big wick here, and then a big price rejection. Oh, a price rejection exactly like that. And then we look at that, okay, what will happen here? Should we go out, or it will break it? And then you see that it make another candle and another candle. So someplace here you basically the best exit point can be that you exit out that, or you exit. So you had basically, as I said, depends on your appetite for the risk. You have the exit point here, you have exit point here, you have exit point here. This is the main exit point. Why? Because of this guy here, these 4 hour structures. Look, if you have not done this, if you have not bring all these market structure from higher market, you say you will never be able to identify these things, these things. But look at that, how much it help you to look at here. So this is the 3 exit point that one can use based on the market structure. So the best one is the big circle here, but here you will look at that, if it goes back then you exit it or not, like we did it here. So but because it goes so fast, I think you would prefer, okay, to wait to see, because I know there is this guy here, I know this guy is here, I will let it go and see how this guy is gonna to react. And then when I see that this guy is having a strong price rejection, that is exactly what we have had that here before. A lot of price rejection, we had that here as well. So that has happened here, and then we exit that, and then we will not enter it because we don't know. We are a key level, we don't know whether that will break out down or go out. We will look at the signal where to enter. We go look at that. Okay, here we see that it's bouncing going back, but we will not enter here. Why? Because it's below the moving averages, where moving average strategy does not allow us to do that, because the price are below that. But the price is telling us that okay, is wrong, is what is called the price is telling us that that is bearish. Okay, we have to get the confirmation before we go. So you see that, so it's falling. If you have gone here that, then you have lost that one, because but thanks to the moving average strategy that we have told you, is that we did not enter, because the price here is far from the moving averages, and the distance between these moving averages are very very big. That's why we will not enter here at all, and we are on the key level to either to break or to bounce. one of the two by must happen. Okay, we will look at that. The price is trying to come off. The price is trying. No, is the price is touching the EMA 20 EMA, is touching the 20 EMA. Still we are not going to enter because it's not good. Again, it's falling, it's hitting the support, and again is doing that. We are not going to enter anything. Again it hit the support, again it hit again it comes up again, again. Okay, no, these from the moving strategy that I told you, that these moving average is not valid for a signal, but it's valid for a support, for a resistance, yeah, but is no more valid for a signal. Why? Because it's touching these candles. So the one that is valid is this 50 EMA. Okay, so we go there. You see that is again is fighting with this. Look at that, how beautiful this market structure is helping you to do that. So it is fighting around this. We knew that either it will break and will go. So if I will remove this one here. What will happen here? It's no, this one also is invalidated. This EMA also is not valid for the signal. Why? Because it touch all these candlesticks, and so is the 20 EMA 20. So both EMA 50 EMA and 20 EMA, they cancel the for according to our strategy. They are, we can no more use this to enter. We know that these are crossing here, but that crossing is not valid, because basically both are coming out from the price. We don't know whether this scenario is happening again or not, so we have to wait. But now we will focus on the SMA 100 SMA. 100 SMA, we will look at that. Oh, here it comes 100 SMA, bah, beautifully it break this candle, it break the body of this bullish candle and goes immediately under. That means basically this is the our perfect entry point. Perfect entry point here, because we have gone all the way here. We cancel these two EMAs because they were touching that, and but this was valid for us, and that is crossing this crossing from above, crossing this bullish candle and goes under these two candles. So we will enter someplace here. So here again we enter that. Okay, we enter that, and we will see what will happen. So it goes here, and then we are very close here. So either you here you will wait for see whether you if you are not wanted to take your profit very early, so this could be exit point for you, but you can also wait here, because why? Because you are far away from moving averages. Here you are far away from moving averages. Instead of exiting here, what you do, you will put your stop loss one or two candles away from the current price on this moving average. So you put your stop loss here and then follow the price. Okay, let's say we put our stop loss here, we follow the price, we don't care about this, and say if it follows, it goes up, it is killing this and that support, the resistance, and then we are following that by our stop loss here. We are locking the profit, we are just following with that the price. We are always, if the price is here, so we will go for two candles back, and our stop loss will be here, and then we go two candles behind the current price, and then we just carry on. So here we exit. Because our trailing stop loss is hitting that one, so okay, so we exited here. Very nice. What we did here, actually, we mastered the three different time frames to get the market structure summarized in one chart, one 15-minute chart. And from that 15-minute chart, we started the price action. For the price action, we followed our moving average strategy, and that moving strategy give us very good opportunities on different points. So we have that. I still recommend that we should not have gone enter the long here. Why? Because it was in the middle of this horizontal channel. I would not, in reality, I would not have done that. I would not have dared that. But depends again. But depends, as I said, one of the principle is your appetite for risk, whether you are a high risk taken or a low, you want to take low risk. If you take the low risk, you will never enter a position in the middle of this channel. Okay, so this is a little tricky here, but again, I repeat, it depends on your appetite for the risk. But then we go only short here, because that is the main trend. The H, this is the H1. This is basically a 4 hours trend. So that is going down. We go for that down, and then we went all the way down here, and here we wait until the moving average strategy told us, okay, when to enter. We did not enter it here. We do not enter it. Why? Because we keep this in mind, that the main trend here is done. We have to make sure that we really get a real signal that this is bouncing, not just because it's just touching these support, and then all these hit the support here. So we did not touch it, but once we got the signal here, which basically the 100 SMA give us a signal about crossing from above, crossing this bullish candle and going under the price, and then that gives us a perfect price, and then we are here confident. But before that, we knew that the price canceled these two moving averages here. So these moving averages was not valid anymore for us to make a decision, and we did that, and then we followed that. And then once we were here, we were following because there was a strong move here, and we were far away from the price was far away from the moving averages, and moving average distance between the moving average was very strong. That means there is a very strong movement upward for these asset. What we will do, we will just put our stop loss a couple of 2-3 candles back on the moving average and following the price, and we did that, and then we bang here, our things hit. Okay, so let's see how to go look for how to choose the correct time frame. Okay, factors to choose correct time frame is that basically it goes back to your personal strategy. What is your personal strategy? Whether you are a position investor, or a holder, or a swing trader, or a day trader, or a scalping trader. Trading. So you need to make decision. If you go for a scalping, then you need to work on much more lower time frame. Maybe take 1 hour and 15, and then go down to the 5 minutes, or even lower, because that you basically wanted to exit within very short time. Okay, if you are swing trader and day trader, I think the best time frame is the one that I did at 15, 1 hour and 4 hours, and you saw yourself how nicely that was giving you the infrastructure, the market structure for the higher, and how the price action was playing. And then the other factor for choosing correct time frame goes back again to your risk appetite, whether you are a high or low risk taker, or how much you wanted to take risk. If you wanted to take risk, for example, you could take that long position that I took it within in the middle of the horizontal channel, which was very dangerous, but I did that for the purpose of this education. So you that was a high risk. But if you are low risk, you never do that. You never enter that in the middle. You always look at that the key level, which is the bottom and the top of the around the support and resistance, or the wall of the channels. And the other one is the factor that chooses is your psychology. How much patient you are, how much impatient you are. If you are impatient, you need to work with the higher time frames. If you are a patient man, you can work with sorry, if you are a patient man, you can work on the lower time frames and make quick decision and exit and enter very quick. And if you are patient, you can go with higher time frames because you are patient to look at the price movement up and down, and that will not affect your judgment. And the other one, it goes back to your life and work style. So if you, for example, a trader, so that you have you're working and you just do that trader as something extra there, then you might at your work not have that opportunity to sit and watch this price movement in 15 minutes and like this, and that basically not allow you to do that. Then you go basically to for higher time frames. But if you have you are sitting home and you are doing the day trading and you have access to information, so you can look at the time frames much lower important. Okay, I wish you good luck. Please don't forget to watch the moving average strategies in order to really make it easier for you to understand this time frame. Okay. Okay, folks, thank you for listening. We have come to the end of this course. I hope that was useful. I hope that you have got some good knowledge about some of the tricks and techniques that I promised you at the start of this course. I wish you good luck. Have fun.